In this video, we're going to continue talking about stock valuation. First thing we're going to talk about is what we refer to as a variable growth stock, or sometimes referred to as a super normal growth stock. And these kinds of things happen from time to time, especially companies that are in very innovative kinds of industries, right? They have a growth spurt because of a new invention, a new product. So we want to understand, how can we deal with this variation? In a very simplified model, right? We need to find the present value of the dividends in this time frame when the company is going to earn a higher rate of return. And then, of course, because they're earning more money, they will pay a greater growth rate in dividends during this period. But at the end of that period, they're going to settle back down to more of an industry or a company standard for future dividends. And once they get down to that industry standard, again, the assumption of a constant growth stock is it's constant forever, then we'll be able to calculate a price at the end of this supernormal growth period. And then you find the present value of the two calculations and you add them up. So let's see how this might work with a company. We have this company, have new invention, toothpaste doesn't require a toothbrush. So for the next 3 years, earnings are going to grow at 15%. Now, eventually it's going to grow, return to an industry average of 8%. So the most current dividend is $2. The required return for the stock is $12, and it's currently selling for $61.75. Now, this super growth period is 3 years. So we have a worksheet that can help us with this. But essentially, the process is this. You need to find the future dividends during the super growth period. And this obviously does it. Here are the future growth periods. We need to know the current dividend, the normal growth rate, the supernormal growth rate, how long that growth rate lasts. So here are the next 3 dividends expected to grow from $2 at a 15% rate of return for 3 years. And then we need to figure out or calculate what we think the future price will be at the end of year 3. And if you remember our formula, the price at year 3, right, has to be equal to D4. So we have to find the 4th dividend, and remembering that now the dividend is growing at 8%, and we calculate the future value of the stock. So once we know the dividends and we know the future value, you calculate the present values and you add them all up. So in this case, the value of this stock is $64.78. And that's obviously greater than the current price of $61.76. So this would be a good investment to make. Now, there are occasions where we might not have this simplified model, that it's a more complicated model. So in this case, we have what we refer to more as non-constant growth models, right? So the current dividend's $2, the weighted average cost of capital is 9%, the end of the variable growth rate period, again, is 3 years, and then there's growth after that of 4%. So again, how does this calculate? Well, what we need to do is we need to know what expected growth rates do we anticipate coming in the future. So in this case, we expect to get 30% year 1, 20% year 2, 10% year 3. Now, once we're at this point, the process is exactly the same. We need to predict the future dividends. $2 at 30% is $2.60. $2.60 at 20% increase is $31.20, etc. We also then to calculate the price out there, since we know what after year 3 the growth is constant at 4%. And again, we calculate the value. We end up with $64.13 as the value in the future. Just another little question. What would happen if dividends are negative? What, not dividends being negative, what if the growth rate of dividends was negative? Instead of them actually growing, they are retracting. Well, in the formula, right, in the numerator, it's the required return or the cost of capital minus the growth rate. Well, if the growth rate is negative and you're subtracting a negative, that's a positive. And essentially all this does is it plays right into the formula. It implies that there's got to be a pretty high growth, right, or return expected if you think there's going to be negative growth in dividends to get a rate of return, right? What rate of return are you going to expect? So since they're expecting this constant growth, dividend yield, and constant capital gains, the dividend yield is sufficiently large enough, right? When you calculate the dividend yield here, you're going to have to offset those negative capital gains. How do we do that, right? So again, it's just a more of a question of what could happen if the future growth rate or the capital gains yield rate, what if you're expecting that to be negative? How does that affect the value of the firm? So with our models, we've talked about these things a little bit in earlier videos. When doesn't this model work, right? If the company doesn't pay dividends, this doesn't work. If the growth rate of future dividends is greater than the required return, this model doesn't work. If this is a company as a sole proprietorship or a partnership, or maybe even a corporation that does not pay dividends, right? A corporation that is not publicly traded. If those instances are true, if any of those things are true, then the dividend valuation model just does not work. We need to have another model. Now, a model that's very popular is something that's referred to as the corporate valuation model. Sometimes we refer to it as the free cash flow model because it utilizes free cash flows rather than dividend payments. So this calculation, though, is not going to be a calculation of stock value. It's going to be a calculation of company value. So we're going to calculate the value of the corporation. Once we know that, we then can try to determine the value of the stock of that corporation. So to find the free cash flow of the company, again, we needed this EBIT times 1 minus T. Now we have to add depreciation and amortization. And from that, as you remember, we're going to subtract out any capital expenditures and any change in net operating working capital assets. Again, we've done this formula and talked about this in other videos. You can refer back to those if you need a little refresher. So if you look at the formula, it should look very similar to the constant growth model formula. Free cash flow, subscript 0, that's today's free cash flow. Multiply that by 1 plus the growth rate of future cash flow, future free cash flow. Divide that by, in this case, it's the weighted average cost of capital minus G. So the formula is very similar, except now the answer is going to be a large dollar amount rather than a small dollar amount because we're talking about the entire value of the company. Because it's the entire value of the company, once we know the value, we can then subtract out the parts of the company, right? So the value of the company, it has 3 parts. There's stock, there's debt, there's preferred stock. So if you take the value of the corporation, you subtract out the market value of debt and the market value of preferred stock, that should leave us with the value of the equity of the company. Now, sometimes we're going to prefer this model, again, especially for those cases where it just doesn't work because of no dividends or etc., right? One of the things that's here true is that it still assumes some of the same things, is that there is a constant growth rate of dividends sometime. So ultimately, we're going to have to calculate or understand something about the horizon value, right? How long out in the future is that? And of course, the farther out it is, the less value that's going to be to attribute to today's value of the company. So let's see what the spreadsheet might look like for one of these calculations. Now, in the yellow boxes, again, if you input all the data, all the information that you know, we can calculate here everything we need to know. What's the weighted average cost of capital of the company? What's the growth rate? What's G? Now, we do need to know what's free cash flow 1. So that means we need to do a calculation, right? We need to know what is the growth rate of free cash flow. We can use a time value calculation if we want. Again, if you know the most recent free cash flow, the beginning free cash flow, just like we did with dividends. Sometimes, though, you can find this number. They will predict what next year's free cash flow is going to be. So sometimes that number is given to you. But regardless, you're going to end up with a free cash flow estimate for next year. Sometimes you'll even be told what the value of the corporation is today. That can help us with some of these formulas over here. Now, we need to know something about the cash available. How much cash is available to the company? This number here, that's the calculation, the value of the company, V sub C. If you input the value of the debt, value of the preferred stock, it's going to give us a picture or an answer here of the market value of common stock. If you want to break this down into per share, you need to know how many shares of stock there are. So again, if there's 10,000 shares, you divide 10,000 into the market value of common here. That will give you an estimate of the value per share. Now, these blanks down here are for a little bit more complicated and a little more advanced kind of calculation. But if you think about it, if you know what the free cash flow is to equity holders, right? You know what that free cash flow is. If you know interest expense, the tax rate, if you understand something about net debt, right? Or essentially the debt that the company has, the increase in that, you can calculate what's referred to as the free cash flow to equity. Putting the cost of equity, the growth rate of free cash flows. We can also calculate the market value of equity and give us an estimated market value. Again, this is a little bit beyond what this course is all about. So here's a company. We have some data. Here's some free cash flow information, weighted average cost of capital. We're given the future growth rate of free cash flows. We know what the debt is, the cash is. We know something about its number of shares. So if we plug into our spreadsheet here, we'll find out that we're telling us that the growth rate is 3%. Given the data we know, though, actually it's been growing at about 10%. So for some reason, we have down or discounted that rate. We don't think it's going to be quite that much in the future. Still growing, just not at that growth rate. This gives us a free cash flow next year of $618,000. When you calculate the value of the company, then Company's worth $10.3 million. The company has $750,000 in cash, $3.5 million in debt, no preferred stock. So if you do the math here, we end up with the market value of common stock is $7.55 million. If you had 300,000 shares, the value of this company's stock is $25.17. And of course, we need to compare that to the current price of the stock. Well, I hope you enjoyed that video. I look forward to talking to you next time.